Hey everyone, welcome to The Explainer. Today, we're completely bypassing the usual market noise to investigate Hims and Hers Health. You probably know them by their stock ticker, HIMS. We're going to look straight at the hard data to piece together exactly what's going on beneath the surface of this incredibly fascinating company. Let's get into it.
Here's the roadmap for our investigation today. First, we'll look at the stock's wild ride. Second, we'll open up the revenue and profit engine. Third, we'll be assessing their financial health. And finally, valuation, is it actually fair? Right off the bat, to set the stage for our investigation, we're looking at a company with a current market cap of $6.204 billion. I really want to emphasize that footprint. We're not talking about some small, scrappy startup trying to figure things out in a garage. This is a massive, established player in the telehealth and personal care space. But, as we're going to see, a massive footprint doesn't always guarantee a smooth path forward.
Part 1. The stock's wild ride.
Okay, let's dive into this, because these annual returns, they tell a story of absolute extreme whiplash. Just look at 2024, an explosive, massive return of 171.69%. I mean, investors who got in early were absolutely thrilled. Then 2025 comes along, and while it's still a very solid year, delivering a 34.29% return, the momentum is clearly starting to decelerate. And now, looking at the year-to-date return for 2026, we're seeing a pullback of negative 15.58%. So the market is very clearly trying to figure out the true, sustainable trajectory of this company after an intense period of hypergrowth.
What's actually wild here is the sheer dramatic spread between the peaks and the valleys. Over a 52-week period, this stock hit a soaring high of $70.43, but it also scraped a low of just $13.74. That is a truly enormous gap. It really highlights a level of extreme volatility. As financial detectives, when we see a stock swinging this wildly from the low teens all the way up into the 70s, we know we absolutely can't just trust market sentiment. We've got to look at the actual business fundamentals.
Part 2. Revenue and Profit Engine.
Now, the numbers under the hood are really substantial. The trailing 12 months, or TTM, revenue sits at a massive $2.348 billion. But it's really the compounding growth that demands our attention here. Over the last 3 years, revenue has compounded at an annual growth rate of 64.48%. And it's not just top-line vanity metrics either. Their net income is growing at a really solid 58.07% over that exact same 3-year period. This shows us that Hims isn't just selling more products, they are successfully scaling their operations and driving real, tangible profits.
And this brilliantly illustrates exactly how the money flows through their system. Check out that massive gross profit margin of 76.31%. Basically, that means their products have incredible pricing power and low production costs relative to what they actually charge. But if we follow the flow of capital, the actual net profit margin, the money they actually keep at the very end of the day, is only 7.78%. A huge chunk of that gross profit is literally being pumped aggressively right back into operating expenses, marketing, customer acquisition, and overhead. Why? Well, to fuel that massive 64% revenue growth we just talked about.
So, let's look at how this builds our understanding of their management's operational efficiency. Their return on invested capital, or ROIC, is currently at 8.71%. Now, you might be asking, okay, so what? Well, ROIC measures how effectively a company uses the capital it raises to generate actual profits. An 8.71% return means that for every $100 Hims invests back into its business operations, it reliably generates almost $9 in profit. It's a really solid number, proving that their leadership is putting their capital to work effectively to generate a real return.
Part 3. Assessing Financial Health. Now, a fast-growing business is great, but only if it has a foundation strong enough to support it, right? Here are 3 absolutely critical metrics we use for a quick financial checkup. We have a debt-to-equity ratio of 1.80, a current ratio of 1.90, and a quick ratio of 1.70. Now, that debt-to-equity ratio of 1.80 tells us they are using a fair amount of leverage. Essentially, they have more debt on the books than shareholder equity. But remember, leverage isn't inherently a bad thing, provided you have the immediate cash and assets to actually manage it. To put that current ratio into everyday context for a second, for every single dollar of short-term debt that Hims owes, they have $1.90 in liquid assets ready to go. They can cover their immediate short-term obligations almost twice over. So despite carrying some leverage, their short-term structural integrity and liquidity are incredibly solid. Part 4. Valuation. Is it fair?
This right here is the multi-billion-dollar question. We know Hims is a rapidly growing, fundamentally sound business operating at scale. But as any seasoned financial investigator will tell you, identifying a great company absolutely does not automatically mean you found a great stock to buy. At the end of the day, the whole shebang comes down to the price you pay. So, is the current price fair?
Let's look at the multiples the market is currently demanding. We have a price-to-earnings, or PE ratio, of 53.75. The forward PE is even higher, sitting at 68.03. We also see a price-to-sales ratio of 2.64 and a price-to-book of 11.52. Honestly, these are undeniably high multiples. A PE ratio sitting north of 50 clearly indicates that the market is paying a heavy premium right now for expected future growth. Investors are willing to pay top dollar today because they're making a bet. They're betting that this 60+% growth engine will just keep running hot deep into the future.
Now here is the big reveal when we run the raw discounted cash flow math. Compared to the last close price of $27.41, the calculated fair value price, which is based strictly on actual free cash flows, is only $18.42. So, the market is currently charging significantly more than what the underlying fundamental math suggests the company's cash generation is actually worth today.
So, the crucial point is right here, a negative 48.78% margin of safety. In the world of intelligent investing, you generally want a positive margin of safety. You want to buy an asset for less than its intrinsic fair value to protect yourself against unforeseen bumps in the road, right? Well, here, we are looking at the exact opposite. The stock is trading at a steep premium, meaning there is virtually zero room for error. If their hypergrowth engine slows down even slightly, well, that premium price tag could face a really harsh correction.
And that brings our investigation to a close. We've uncovered a really fascinating dynamic today. Hims is a company with an undeniable powerful growth engine and solid short-term liquidity. But it's attached to a stock chart that swings wildly, and a valuation that carries a very hefty premium with literally zero margin of safety. So, with all these numerical clues laid out clearly on the table, what's your next move, detective? Thanks for joining me on this explainer, and keep learning.